Jay Pelosky. Jay, hello. Good morning for you.
Hello, Marta. Good afternoon. How are you?
So, the April employment data showed that the demand for workers remained strong as net hiring advanced 422,000. However, the supply of available workers declined as the labor force participation rate fell to 62.2%. What does it mean?
Well, I think those numbers were kind of roughly as expected, and you see that in the market reaction across assets, right? Stocks are down, but I think that's kind of a little bit of a fall through from yesterday's shocking decline, and bonds are roughly around the same levels as they reached yesterday. I think really the important number, Marta, is in the average hourly earnings, which came in significantly below or not significantly, but below expectations. And actually on a 3-month annualized basis, it's the lowest in over a year at 3.7% year on year. That compares to a peak in November of 6.3%. So if you're worried about inflation and you're worried about a wage price spiral, the average hourly earnings number is actually a pretty good number, because it suggests that that wage price spiral is unlikely.
So, do you think that these average earnings mean that there are less inflationary wage pressures?
Yes, I think that's exactly right. And the markets are really divided into two camps. One camp is very concerned about inflation, and yesterday saw those unit labor costs skyrocket, and that's what really hit the bond market. The other camp is very worried about growth, and they saw the poor productivity numbers from yesterday, and they worried about margins and earnings, and so sold equities. And that helps explain why the cross-asset sell-off was so dramatic. I think there's a middle path where inflation is going to start to roll over, yet growth is going to be okay. And we're going to see inflation around 4% towards the end of the year, and the Fed will be able to navigate this path. It's really not the destination, Marta, as a famous American poet, Ralph Waldo Emerson, said. It's not the destination, it's the journey. And the investment community is on quite a journey to find out how the economy is going to work in the coming quarters.
Okay, so let's look at the details. Job gains were broad-based, but the services sector continued to lead the job creation. What do you think about it? What other sectors are creating employment?
Well, yes, that's exactly what's happening. There's so many transitions post-COVID that it's very challenging for investors to keep to understand all of them. And one of them that's very important is the shift from a goods demand-driven economy, which we saw in 2021, to as COVID was in full force and people needed to stay home, they bought stuff. Now COVID is ebbing, and so the service sector is starting to take the leadership in the economy. And that's important because the US, Europe, the developed economies, Japan, are mostly service, right? Service is 65 to 75% of the economies, and that's the segment that is starting to pick up as COVID ebbs. And that's one of the reasons why we think it's wrong to be too concerned about growth. We think growth is going to be fine.
Jay Pelosky, thank you so much for attending us. Have a nice day.
You too. Happy weekend.